This video is provided strictly for general educational and informational purposes only. It does not constitute financial, investment, legal, or tax advice and should not be relied upon as such. The views expressed are based on publicly available information, assumptions, and personal opinion at the time of production and are subject to change without notice. As we enter 2026, investors are facing a world defined not by stability, but by transition. Political realignments, economic restructuring, technological disruption, and ongoing geopolitical conflict are reshaping how capital moves globally. In this video, we will explore the major investment themes that are likely to define 2026 and how smart money is positioning for what comes next. The macroeconomic environment in 2026 will remain fragile and highly volatile. Political uncertainty, social tensions, and economic upheavals are no longer isolated or temporary events. They are becoming structural features of the global economic system, shaping investor behavior, market sentiment, and capital allocation decisions worldwide. In times of uncertainty, investors traditionally turn to gold and silver as safe haven assets. While gold and silver delivered strong performance in 2025, the outlook for 2026 is fundamentally different. Gold and silver are expected to remain important portfolio hedges, but their prices are likely to be range-bound rather than producing another year of outsized gains. This reflects a market that is already priced in geopolitical risk, inflation concerns, and monetary uncertainty. Oil prices are expected to remain under pressure throughout 2026. This is due to geopolitical change combined with deliberate policy decisions aimed at controlling inflation across major economies, rather than collapsing demand. Political changes in sanctioned oil-producing nations like Iran and Venezuela could bring meaningful volumes back to the market. At the same time, the United States administration is expected to favor lower prices as part of a broader natural gas strategy to combat inflation in 2026. Lower prices do not mean fewer opportunities in the energy sector. The real benefits will go to energy companies that are permitted to invest and operate. In 2026, opportunities will rise in LNG, oil, and gas infrastructure, driven by geopolitical access, scale, and operational leverage. The US dollar is expected to continue to weaken against major currencies in 2026. This is a result of a change in Federal Reserve leadership, combined with expectations of lower rates and renewed quantitative easing. Global capital will seek opportunities outside the United States. Historically, a weaker US dollar leads to increased capital flows to emerging and non-US equity markets. Investors seek higher growth, improving currency dynamics, and more attractive valuations. Singapore and Hong Kong are particularly well positioned to benefit from these global capital shifts. Geopolitical conflict will remain a defining feature of the global landscape in 2026. Wars like Russia-Ukraine show no sign of resolution. As such, governments worldwide are increasing defense and security spending at an accelerated pace. The primary beneficiaries of rising defense budgets will be companies involved in drones, autonomous systems, and national infrastructure. It has become a larger industry, including strategic national infrastructure. One of the most disruptive technological developments emerging in 2026 is quantum computing. As quantum systems push past 100 qubits, markets will make massive assumptions around quantum data labs and magnetic computing. This technological transition will not be smooth. AI-related stocks and cryptocurrencies may experience sharp volatility and nonlinear corrections. Confidence in existing graphic security may weaken due to quantum capabilities. Investors navigating 2026 should focus on strategic balance rather than aggressive speculation. Gold and silver held in a portfolio, Singapore and Hong Kong offer stability. Emerging markets and defense security innovators provide long structural growth, while technology investments should focus on genuine innovation. 2026 is not a year for passive investing. It is a year that demands strategic thinking, discipline, and awareness of the global economy's opportunities.